Can't you see that love is everywhere? Step into the confusion. Can't you hear the sound that's in the air? It's rock and roll. 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 It's rock and roll.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. It is the Hump Day edition of The Real Investment Show. That's right, halfway through the week and already getting ready to head into back to school shopping season. That's all coming up here, and that's one of the interesting things here. You know, a lot of discussion here as of late about the first 2 quarters of GDP growth were negative. So clearly we're in a recession, right? Well, maybe not so fast. And we've talked about this, you know, before and have discussed this. Yes, the first 2 quarters were negative, but there were still some aspects of the economy that were still in growth mode, namely employment was continuing to expand. And so when the National Bureau of Economic Research looks at the economic data, they are looking for a definitive slowdown in economic growth over 2 quarters. Now, we relate that back to 2 quarters of economic growth, but there's several factors they tend to look at. The other side of this is that also we could very well see a bump in economic activity in quarter 3 and quarter 4 because of just seasonal trends of the economy. And again, when we start looking at what we have going on right now, everybody's getting ready to go back to school, got to buy new clothes, new stuff, send kids back to school, right? Shopping gets to pick up here a bit. So that consumption tends to feed back through. So it wouldn't be surprising that we might see a very small uptick in economic growth in quarter 3, maybe even quarter 4, because of what's happening with retail shopping season, Christmas, Thanksgiving. If you didn't know this, by the way, October 31st, Halloween, is one of the biggest retail shopping days of the year. So everybody goes out and buys lots of Halloween stuff, candy, etc. Big shopping day. So that's all additional inflows into the economy. Because again, consumption makes up about 70% of economic growth. So again, it's these holiday shopping periods are, consequential to supporting the economic growth. So again, we could very well see some positive economic growth in quarter 3, quarter 4, albeit light, small amounts of growth is possible. And most likely we won't see the actual recession, official recession until 2023 as all these Fed rate hikes. And again, one thing we'll talk about this morning is the CPI report coming out today at 7:30 this morning. All eyes are watching that CPI report this morning. Will the Fed hike rates? Will the Fed be more aggressive? Will they start to taper? That's all everybody's focusing on right now as it relates back to the financial markets itself. But The question here is will as the Fed continues to hike rates, and they've been hiking rates since March, right? So we've had the rate hikes in March, and then in July we're gonna have more in September, and those rate hikes take about 9 months to show up in the economy. So a lot of these rate hikes haven't even impacted economic growth yet. That won't occur until 2023. So the real risk of an economic downturn, if we're going to have one, is going to be in 2023. Not really kind of front-loaded in 2022. And that's also what yield curves are telling us, right? So yield curves, that is, if you're not familiar with what a yield curve is, the yield curve is when one set of interest rates, say like the 10-year interest rate, is lower than the previous or the shorter yields on bonds. So like 1 year, the 1 month, the 1 year, the 2 year. If the yield on the 10-year is lower than the shorter end of the curve, that's called an inversion. And what that means is simply is that money is coming back in, and people are only willing to loan out money short term. They're not willing to loan out money long term because they're unsure of the economy. So that's why yield curves tend to be a good recessionary indicator, but not when they actually invert. This is one of the mistakes that people make. They say, well, the yield curve is inverted, that means we're in a recession. No, that's really not what it means. And that's also why the first 2 quarters of this year were also probably not a recession, because what the yield curves tell you is when the economy actually moves into recession, and we won't know this till after the fact, but the yield curve will uninvert as money starts to move into safety. So it moves out of short-term risk into long-term safety. That's 10-year treasuries. And so the yield curve uninverts at that point. And even though it may be another 6 months or so before the National Bureau of Economic Research actually dates the recession, the yield curve uninversion, after it inverts and remains uninverted for a few months, as it has been right now, we will see that uninversion. When that uninversion occurs, that's where most likely the recession has started. So again, lots of indicators right now suggesting that yes, the economy is very weak, certainly not improving. The National Federation of Independent Business out yesterday with their monthly report showing that sales expectations. Now this is the big driver of small businesses. Small businesses are the heartbeat of America. Expectations for sales are plummeting, right? I mean, the small business owners are just like, man, we are just terrified about what's about to happen with our sales. They're starting to cut back on CapEx plans and their outlooks for hiring, etc., all turning down because of concerns about what's happening in the economy and what's going to happen. So again, a lot of these indicators are telling us a recession is coming, not that we've already had one. So again, a lot of this is all kind of playing to this base. But again, the Federal Reserve in particular is going to continue to hike rates right now to fight inflation. Why? Well, because unemployment is strong. Unemployment hasn't reverted yet. It will as the economy moves into recession. And right now, a lot of companies, and we saw this yesterday with the productivity report, right? So productivity by employees dropping sharply. Employees are being much less productive, Brent. They're being much less productive at their job, but they're getting paid more. So we have rising wage costs and lower productivity. Now, what does that mean? Well, that's this is part of what feeds into inflation as well. These higher wages, in order for companies to retain or hire employees right now, they're having to pay more for them. That gets passed on to consumers. So while we may be seeing some relief in inflationary pressures at the gas pump, such as gasoline and energy prices have come down recently, food prices are coming down in some areas. While we're seeing some relief there, right, these wage costs have to either A, be passed on to consumers, which means higher inflationary prices for consumers on stuff that they buy or consume, or companies have to start cutting back on labor, and that's where we start getting these layoffs and pick up in unemployment. Typically, once companies have passed on as much of that wage pressure as they can to consumers, in other words, consumers stop buying because, well, costs are just getting too high, well, that's when the layoffs start to come. And again, we're just at that part of the cycle where companies are still able to pass on some of those costs, but at this point, still being able to absorb some of it as well, and earnings are still okay at this moment. But as this continues to weigh on companies' corporate profitability, the layoffs will come. That's just a function of time, unless we have just a miraculous recovery in the economy for a whole variety of reasons I can't even imagine right now. But if somehow miraculously everything was to turn on a dime and we were back to substantial economic growth, it'd be a different story. But there's really no catalyst right now. Right? The Fed's continuing to hike rates. They're continuing to decrease their balance sheet. There's really nothing on the horizon right now suggesting the Fed is going to pivot away from that. And again, outside of that, there's really not a lot of catalyst at this point to help speed up economic growth. And again, faster economic growth, if you got it, would also create what? Higher inflation, which means that the Federal Reserve continues their work to lower that inflationary pressure and lower economic growth. So again, the whole point here is that there's not a lot of sun on the horizon for a stronger economy right now. The weakness really looks to be in front of us, not behind us. All right, quick break. We're going to come back. We'll pick up a little update on the markets where we are this morning. Of course, we're going to be talking about the inflation number coming out at 7:30 this morning. What does that mean for the markets and more importantly for the Fed? We'll talk about all that coming up on the Real Investment Show this morning. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Could your job still be at risk? A new normal can still include new obstacles. A severance package can be an emotional as well as a financial decision to consider. Wouldn't it be comforting to review the options for you and your family with an objective financial partner? At RIA Advisors, we're here to help. From severance pay, tax timing decisions to how to maximize unemployment benefits, the RIA team wants to make sure you can do what's best for your family. There's no charge for a consultation, so reach out to RIA Advisors, 855-RIA-PLAN, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Welcome back to the show this morning. It is, of course, Wednesday as we have things going. Flying solo this morning. Danny Ratliff a little bit under the weather. I think he's just sleeping in, honestly. Let's be honest. Me and Brent, we're here whether it's sickness or injury.
Without fail.
Without fail. And then Danny gets a little sniffle and he's at home all curled up with his blankie.
Well, he's got all those Petri dishes on legs running around his house.
You know what, though? But I had that.
Yeah?
I had 4 of them.
Uh-huh.
You know what happens? Your immune system gets a lot stronger. That's all I'm saying, It's so funny, too, because, I watch these young parents, and they're like, it's like, oh, don't go around so-and-so because they're sick. And when I was raising my kids, I was like, oh, Jimmy's got the flu? Go play with Jimmy.
Oh, yeah. Or the mumps.
Yes.
Has your kid had the mumps yet? No. Can he come over and play with my kid?
Exactly.
That kind of thing.
Exactly.
Let's get it out of the way.
I know. Better immune system. Now my kids don't get sick. It's like,
right.
They're
we used to eat dirt, so.
I know. Well, so did my kids. So That's how we fed them. Go eat dirt.
Roughage.
Drink out of the garden hose.
That was the best water.
It was. Still is. It's not great for you, but.
No.
And then, of course, in the summer, it was like 900 degrees coming out of the hose. But
Oh, yeah.
yeah. All right. Quick thing. Let's jump over here to our chart this morning. Just kind of take a quick look at the markets. And we'll talk about inflation here in a second. The CPI report is out this morning, and of course, this is really the breath moment, right, for the markets. And over the last couple of days, as we've been talking about, the market's really not gone much of anywhere. Just really have been kind of consolidating in this, kind of very tight range here over the last, 4 or 5 days. And again, this is all kind of pushing right back up on these previous tops that we saw back in really kind of, this kind of May, June, late May, early June period. Markets had rallied, consolidated for, about a week or so, and then finally broke down and went and set new lows. Now, I'm not saying that's going to happen here, but we have that very same type of action here. Markets were very oversold. We had this nice rally. Markets have run up into previous resistance levels and have now been consolidating along the bottom of that resistance level. So it's been unable to get above that resistance level, but it is, fighting with it and holding in there so far. So, it's actually pretty good. The problem, though, now is that we're starting to trigger early sell signals on some of our indicators. And the most important one, which is our moving average convergence divergence indicator. It's a MACD if you're familiar with technical analysis. But basically, it just kind of measures price momentum and, is it improving or is it weakening? And we're starting to see some signs of early weakness. And again, those sell signals tend to be pretty decent for the markets in terms of saying, hey, this is kind of a risk-off period for the market. Doesn't mean you go sell everything, right? Never recommend doing that. But, when you get these, kind of more important sell signals in the short term, it's at least kind of be aware it's a risk-off area. It doesn't mean that everything's going to go down in price, but we're certainly in a point of time where you'll be more cautious about where you're putting assets and putting capital to work. And that's kind of where we are at the moment. So again, as we kind of take a look at the market, we're still very structurally within a downtrend of the markets ever since this March rally that we had back here and since the beginning of the year. Markets are still in a downtrend, but it's not been terrible, right? It's not been this terrible sell-off in the markets of 30-40%, a real bear market. We're still in a correction. We talked about this yesterday. We're not in a bear market. Feels like a bear market because we just can't really seem to get anything going on. And if you take a look at recent articles, everybody's like, oh, it's a new bull market. Bull market's back. Well, no, we actually never left the bull market. We're just in a correction within an uptrend at this point, going back to 2009. Markets have been very, very solidly higher. And still, it's hard to say you're in a bear market when you're still, about 22% higher than you were at the peak of the market in March of 2019. So, considering you've posted up, 10% annualized returns over the last 2 years, it's not been really a bearish type of market. So as bad as it may feel for you this year, it's always important to keep things in context. Markets don't, while we kind of reset our expectations on the first of every year, you got to keep things in perspective. Looking back over a couple of years, where are you from a couple of years ago, where you are now? Still clearly in a bull market, not a bear market. But doesn't mean that can't change, obviously. And this is the one thing that we continue to kind of pay attention to. Valuations are still very high. Right now, we're currently running about 30 times earnings on the S&P on long-term CAPE adjusted valuations. We've talked about that before. Trailing earnings, trailing valuation still very high. The deviation of price from the long-term exponential growth trend that goes all the way back to 1900 still extremely elevated. We're more than 100% above that long-term exponential growth trend. That has only happened a couple of times in history, 1929 and 1999. Right, that's about the only 2 times in history we've been this elevated above that long-term exponential growth trend. And in order to have an exponential growth trend, obviously, prices have to revert back below that growth trend over time. Otherwise, the growth trend would start to just curve upwards. So again, there's a lot of concern here, obviously, and as this inflation report is such a key metric, because all eyes have we're now solely focused on the Federal Reserve, right? We no longer really pay attention to fundamentals. It's like, Lance, that's great. You're talking about valuations. Who cares? Valuations really don't matter anymore. Nobody pays attention to valuations. And you're right? I mean, this is the way it's been over the last, 12 years. Fundamentals don't really matter. It's whatever the Fed is doing. Is the Fed increasing interest rates or decreasing interest rates? Are they increasing their balance sheet or are they decreasing their balance sheet? That's really all that markets have pretty much paid attention to. It's all been about liquidity. It's all been about access to capital. And there's just a lot of it. And of course, over the last 12 years, as we talked about yesterday, a lot of people upset with capitalism, right? Capitalism's broken. It sucks. Well, it's not really capitalism that's broken. It's corporatism that's the problem. And a lot of that's been fostered by the Federal Reserve. So not surprisingly, since the mantra of the market over the last 12 years has been don't fight the Fed, well, everybody's hoping that the Fed will stop fighting them. Everybody wants the markets to go up and the Fed saying, we're okay with prices coming down here a bit because we need to fight inflation. And now the markets are going, stop that. Would you please pivot so that stock prices will go back up? And it's interesting because, retail investors already are making that bet that the Fed is about to pivot. All of a sudden, the Fed's going to give up their inflation fight and turn back and start supporting financial markets. Investors piling into companies like AMC, GameStop, etc. Big moves in those stocks. Coinbase up 90% like in 2 weeks, right? Of course, you look at a chart, you really can't tell that because, it's still down 60, 70, 80% from its peak. But big rally over the course of the last 6 weeks. I ran a table yesterday. I've got an article coming out in the next few days. But I ran a table yesterday, and I'd done this study before about 6 months ago, and I ran all the stocks that were down, a lot from their 52-week highs. And, there were just a large number of companies at that time. There were like 800 companies that were down more than 20% from their peak. And these are all companies that had $7 billion or more in terms of a market capitalization. So this is all the stocks right? So this is Tesla, and Netflix, and Roku, and Coinbase, and Palantir, and all these companies, right? They're all in there. And what's interesting is that I ran that list again yesterday after this nice rally in the markets that we've had. And that list actually expanded to 1,300 companies. There's a large number of companies, and all these names, right? All the names and love are in this list, with the exception of companies like Apple, which is only like 9% off of its 52-week high. But there's a ton of companies in the market right now that are down 30, 40, 50%. In fact, I'm for the article, I've got 120 companies that are, the most oversold from their 52-week highs, and they're all down more than 40%. So again, while the market, the S&P is only down 15% from the peak, while the S&P is not in a bear market, it's in a correction. There's a lot of stocks that are in bear markets. And, part of the work that we're going to have to do is determining when we can start to find these diamonds in the rough and start buying them. And you're going to have to hold them for a while, right? You're going to have to buy stuff that's not going to move around for a while and just sit on it with the expectation that once the market gets through what it's got to do, that you've bought some value stocks at very low prices. And that's, it's interesting when you're talking about high growth stocks being a value, because some of them actually are. They're out there. But you have to do the homework and do it. And then, of course, you're going to have to, buy them and sit on them and wait for them to come back and price. It's going to be a while. It's going to take a while. But part of this, interesting paradigm that we're in right now is that there's a lot of people just hoping that the Fed is going to pivot. Jim Cramer. When the Fed pivots, you got to buy stocks. Right? Well, there's no indication right now that the Fed's going to pivot. There's no indication that things are going to change. And again, this morning, we're going to get this inflation report out. And we'll talk about that after the break. Expectations are that we're going to see the inflation rate tick down to 8.7% this morning. Now, if that happens, or even if we tick down to 8.6%, stocks will probably scream higher today on expectations that the Fed is winning their fight and they're close to the end of their battle. The question will be, are they really? We'll talk about why they may not be when we come back from the break.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Mexico is now upset. There's been like 1.5 million people, a lot of them from California, have now moved to Mexico City because of cheaper rent. Now Mexico City is getting very upset because they don't like the impact on their culture.
The Real Investment Show podcast.
Mexico City is getting very upset with the immigration and they want to stop it.
Don't American by Mexico.
Exactly.
At realinvestmentadvice.com.
It's like, stop it.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Have market gyrations caused you to lose sleep? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. If you think it's time to work with an advisor who puts your interests first, it's time for Real Investment Advice. RIAadvisors.com.
You're listening to The Real Investment Show.
So this morning, we're going to get the highly anticipated CPI inflation number. Now, expectations are this morning it's going to come in about 0.2 to 0.4%, somewhere, depending on the analyst that you take a look at. And that's going to drop the inflation rate to 8.7% on a year-over-year basis. Now, just as a quick reminder, okay, this is all about math. So the inflation rate doesn't print when we get inflation, right? So CPI will come out and it'll say, okay, inflation was up 0.2%, whatever it is. Well, that's not the way that the actual index works. The index is a number. So it's like 258.7 is the actual CPI inflation index number. And that index just kind of grows over time, right? Because inflation is always growing over time. Now there's little hiccups, where we've had a deflationary period, but generally the graph goes from lower left to upper right, right? That's inflation. What we're measuring is the month over month and year over year change in that index. So as an example, let's say the index was 100 and the index goes to 100.02, right? So we're moving up. So the change on a month-over-month basis was 0.02%, and that's what we put out there. We say, oh, inflation was up 0.02, right? So whatever it is. The year-over-year change is simply looking at where this index was a year ago. So if today we're at 108.6, and last year was 100, we're up 8.6%, right? So that's how you get your inflation. So it's just a function of math. Now, here's the important thing about this. It's what you're comparing to that is going to drive the inflation number. So again, when we go back and look at this time last year, where were we in terms of inflation? Where was the inflation index a year ago versus today? Now, interestingly enough, we're in a period where inflation was a little bit weaker last year. So the year-over-year comparisons are a little bit more favorable. Now, in the next couple of months, I've said that backwards. Right now, we're in a period where the year-over-year comparisons were fairly high, so it's a little bit more favorable right now, and this is why we'll see a lower rate of increase potentially this month than we've seen in previous months. But when we get to 2023, we're going to start seeing these big comparisons. Like in May, we had a 1.24% increase, right? So just a really big jump. And so we'll compare to that next year, and then we'll see a bigger drop in inflation at that point because of the year-over-year comparison. So again, just you got to keep this in mind. This is all about how math works. So right now we got a little bit of favorable environment for a read. And so again, we could very well see inflation come down. Now, stock market's going to like that potentially if we see a weaker than an inline or weaker than expected number that shows maybe inflation has peaked. And the reason the market should like it, and this has been the mantra now for the last couple of weeks on this rally, is that, maybe that means the Fed's close to pivoting. Well, what do they mean by a pivot? What the Fed's hoping for is that what investors are hoping for is that the Fed is going to stop hiking interest rates. That's one. Step one, stop hiking interest rates. Step one, okay, fine, you're done tightening policy. Well, stopping hiking rates and a reversal of rate hikes and a reinstatement of quantitative easing are very different things. If the Fed just simply pushes interest rates up and then hangs there, right? So they stop hiking rates. The Fed comes out and says, okay, we're done hiking rates. Now, the market's going to take that as favorable, saying, okay, well, if they stop hiking rates, that means they're getting ready to start cutting rates. That's not necessarily the case. As we've talked about, there's no, the markets are really kind of working against themselves currently. If you want Fed rate hikes to stop, and if you want the Fed to go back to QE, the market should be just selling everything they have, right? If the investor group mob mentality was all like, hey, let's get the Fed to go back to quantitative easing, everybody sell everything, right? Because what is going to require the Fed to go back to their monetary accommodation is going to be financial instability. Right now, their focus is inflation. That's their big fight. And right now, the markets are doing just fine. Credit spreads are declining. High-risk junk bonds are doing fine. There's no credit risk in the markets right now. Asset prices are doing fine. They've been rising over the last couple of weeks. So this is pulling all the pressure off of the Fed. There's no financial instability right now to push the Fed to start cutting interest rates and looking at restarting quantitative easing. They're big folks. They don't like having a $9 trillion balance sheet, right? They want to get that down so that they can use that balance sheet tool again at some point in the future. If it just hangs up here at $9 trillion, that really limits their ability to operate to some degree. Inflation and interest rates, right? They've only got right now about 2.25% of interest rates to drop back down to zero. That's not a lot of room either. They would prefer to have it at 3.5 or 4. So when they start cutting rates for the next recession, they've got room to really use that tool to help stabilize the economy. But as long as employment's doing fine, the markets are doing fine, credit risk is doing fine, there's no reason for the Fed to stop fighting their inflation fight. Even if inflation comes down to 8.7%, that is still the highest level in 40 years. When we had the last time we saw 8.7% was earlier this year, we were all freaking out going, oh my gosh, that's the highest rate in 40 years. Now we're going, man, if we just get back to 8.7%, it'd be great. If the Fed wasn't going to cut interest rates and stop hiking rates at 8.7 when we were there previously, they're not going to do it now. But nonetheless, the markets are going to take this expectation most likely. And again, I don't have any idea how the markets are going to react this morning. We'll just see kind of how the number comes in and what the markets do. But the expectation is that a lower than expected inflation print or an inline inflation print should kind of spark a rally in stocks. We'll see if that happens. A higher than expected number, obviously, would mean the Fed has to be more aggressive. That's not going to play well for stocks this morning. And we're all starting to debate on whether or not September. Now, remember, coming up in September, we've got two big events for the Fed coming on. We've got their September meeting, FOMC meeting, where they'll announce their next rate hike and really talk about what their stance is. We also have Jackson Hole, which is the annual economic Fed Reserve central banker symposium confab hee-haw that they have at Jackson Hole, Wyoming, once a year. And that's where all the central banks of the world come together and they talk about, how they're going to manage our lives. How they're going to manage interest rates. So two big events coming up next month that can certainly set the tone for the markets at least over the course of the last quarter of the year, and we'll see. Now, after September, you have another meeting in November and December, and then you get back into 2023. So, a lot of stuff can happen here. And again, this is why you want to be a little bit careful. Markets have been rallying nicely over the course of the last couple of weeks. That's great. Again, we're overbought. We've got some early sell signals in place. But again, doesn't mean markets have to sell off. We could just kind of consolidate here a bit. If the news is good today, see the markets rally. If we can break above resistance, that kind of sets the market up to move a little bit higher here. But we are getting into, we're still in very overbought territory. So upside is probably limited at this point. And again, a lot of it's going to really come down to not just what the inflation print is today, but then what a lot of the Fed speakers start to say. Now, remember, the Fed trots out speakers on a regular basis to kind of deliver the tone of their positioning, dropping little market hints. And I suspect that even with a softer inflation print, we're going to see a lot of talk, even from guys like Kashkari, that says, look, we've got to fight inflation. That's our big focus. And I don't think that there's any incentive right now for the Fed to start, cutting rates, for sure. And there's certainly no incentive for them to start doing QE. And again, if those have been the market drivers of zero interest rate policies and quantitative easing have been the drivers for the markets over the last 12 years, there's a very high correlation between those. then just because the Fed stops hiking rates doesn't bring back the juice, so to speak, that has been supporting asset prices. So again, I think it's and my point about this is that this is a very difficult market to navigate. And so don't just take one bit of data and extrapolate that out and say, okay, well, the bull market's back, because there's so many factors that are currently, weighing on markets that it's not as simple as just the Fed stopping hiking rates. There's more factors to it. Again, valuations do matter. Again, earnings matter. Again, corporate margins matter. And all these are under pressure. High labor costs, weaker economic growth, weaker consumption. It's all kind of weighing on the back end of this earnings environment. Earnings are coming down. Estimates are coming down, right? Those are getting weaker. But again, a lot of this manufacturing data suggests there's still more to go. So just be careful here of making a one-sided bet in an environment where there's so many conflicting pieces of information at one time. It's a very difficult market. And so sometimes it's better just to wait and let the markets tell you what it wants to do rather than trying to predict what markets wants to do. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So I saw one of the, these, a lot of people like on TikTok and these other social media channels, they post these transformative videos, right? Where where they say, I'm going to start changing my life, and I'm going to start working out. I'm going to film myself for 6 months as I go through my transformation. And so somebody sent me one yesterday because we're always talking about health and fitness, and why it's important for your longevity in terms of not only your lifespan but also your money, and why taking care of your health is very important from a financial aspect. So anyway, somebody sent me this video of a guy. He's starting a 6-month journey of transformation. So it shows him. It starts out, and he's doing his push. He's got like one push up, right, and then it kind of fast forward, and of course, as he gets further in, it's this guy with this ripped 6-pack and lots of muscles and striations, and the guy's doing curls, and you see him from the neck down, right? And then about this time, the guy that started the video comes walking. Is like. Yeah, it's talking about how much pain it takes to, do all this. He's like, yeah, I never really started this. My buddy Juan. And I'm like, yeah, that's about right.
Was it Geico that had the series of commercials where a similar circumstance? You see a flabby old guy, working out, and next thing you know, is slightly buff and then slightly more buff. And it was a Geico commercial, I believe.
Okay. Yeah, I don't remember that one.
Okay. It'll save you 15% on your insurance.
Well, they did. Yeah. Yes, they actually did. So we'll see. But like I said, we have talked a lot about retirement planning, and of course, why taking care of your health is important. And again, we're seeing an escalation now in the terms of old people now moving into retirement, and we've taken on this kind of this attitude. Even in the general media now, is like, well, you don't need to worry about this stuff. It's fine. Just YOLO. Just you only live once, so just do it all as best you can do. And it's interesting because again, when you take a look at the statistics of the average American, they don't have a lot of money saved up for retirement. They've been YOLOing their whole life, and they bought houses they can't really afford. They buy cars they really can't afford to drive, and they do a lot of things financially that impair their outcomes in the future, and they don't invest enough. They don't save enough. They make a lot of mistakes. And this is compounding the problem that as they get into their older years, right? They haven't taken out things like long-term care insurance. It's something that is always an interesting conversation with people. It's like, have you thought about long-term care insurance? Like, I hate insurance, right? It's terrible. You just pay the insurance company money and then you never get your money back. And I get it, right? But you have car insurance, right? And you may not like paying. I hate paying car insurance. Right, but I'm certainly glad I have it if I ever have a wreck, and that's why we have insurance. And insurance is something that we all want to try to avoid. We don't buy the proper type of life insurance. We don't buy long-term care insurance. We don't provide, we don't take care of the things that we need. We don't insure the things that we need to insure. And then we get into these latter stages of life where we have this little nest egg of money that we're all depending on living on. And then, illness sets in, catastrophic cost, wipes out the nest egg. And this is not an uncommon occurrence. And I have these conversations with Chris Liebum here at our office all the time and talking about, why insurance is such a hard sell for people. And it's just a function that, as these are just kind of issues of mortality that we don't want to face. That's really what it comes down to. I don't want to really pay for long-term care insurance because I feel like I'm kind of wasting money right now. I'm healthy, right? I work out every day. I take care of myself. I eat right, whatever your excuse is. I don't really need long-term care insurance because I'm okay right now. Problem is that when you figure out that you're not okay, it's too late. You can't get the insurance because now you're uninsurable. And I have a story of a client I was working with a few years back, and we were talking about buying life insurance on him, and setting up his estate plan, and he had a good amount of wealth, and he was doing fine, and kept him hauling around. He's like, well, yeah, it's just insurance. It's I just have to pay this premium every year, and it's just kind of money kind of going out the window. I could be investing that money. Hey, I get it, right? And so we're finally almost getting to the point to where I've got him convinced that he needs this life insurance policy to hedge his estate. And he keeps putting me off. And then just before Christmas, he calls me and I'm like, hey, how you doing? He's like, well, I just got diagnosed with cancer. Now, fortunately, it turned out that it wasn't terminal. right? So it was curable. So that was a good thing. But the problem is it made him uninsurable. And this is the problem. By the time that you find out that you have this issue, right, it's too late, and it causes a whole variety of other problems. And then, of course, you spend a whole lot of money, dealing with those causes. And unfortunately, if it turns out to be a non-curable form of cancer or some other form of disease, it can be extremely costly. And this is why, we talk about when people get into retirement and later on in life, that the end of life period, right? That last 10 to 20 years of your lifespan, you can eat up as much as $350,000 just paying for healthcare costs. Now, that may not sound like a lot of money right now, but considering that the average person going into retirement has less than 1 year's salary saved up, in other words, less than $100,000, $350,000 is a problem, and that's problematic. So again, I'm not trying to promote insurance. That's not what I'm trying to tell you to do. What I'm trying to, the point I want to get to here, and the point I'm making is that, we don't pay attention. We pay so much attention to what the market's doing today. What's inflation going to do? What's the market's going to do? How do I need to invest? So we pay so much attention to our money now, right? But we don't pay attention to the things that can take our money away in the future that have absolutely nothing to do with the markets, right? So we don't do the right type of planning. This is why Danny and Richard and Chris Liebem, who runs our insurance agency, these guys do great jobs of doing that financial planning, hedging that risk. My job's just to manage the money, so I focus on the here and now. That's my job. Their job is to focus on the future. And why, financial planning and all these type of things are so very important, because it's that end of cycle that gets you. Those are the things that we can't plan for because we don't have any idea how it's going to manifest itself. And then it's not necessarily, we're talking about, unfortunately, cancer or some type of disease, right, that pops up, and they're very commonplace and they're not going away anytime soon. But there's also just a whole variety of other things that happen. Catastrophic accident, right? Paralysis, these type of things. There's all these unknown events that can occur, and if we haven't planned for those, it can wipe out everything that we've done financially to protect our family, right? And again, why do we do this, right? So you're listening to the show right now because it's boring. And because, it's all about money. And there's very few people that listen to shows like this because it's boring, right? It's about money. And nobody likes to really talk about money. But, you're taking a very active role in this to make sure that you're building wealth, not just for you, but for your family, right? That's who we all want to protect, right? I don't work every day as hard as I do for myself. I mean, personally, I don't need a lot. I could be sitting on a beach right now, doing sand combing and getting tips and be okay, but I do this to protect my family, my kids, and my legacy, right? That's why you do it too. And that's why it's important for both of us to be thinking about these bigger consequences that come down the road. And we don't do that because, again, we're kind of all wrapped up in what we're doing now, but it's just something to think about, right? It's something that if you haven't put a lot of thought into it, and again, it's morbid because we're talking about mortality. My wife hates when I bring up estate planning at home, right? I mean, she will try to find, she's like, oh, look, there's a spot on the carpet, right? Just anything to avoid the conversation about mortality, because the last thing that she wants to think about is me not being there. Although I'm pretty sure she's poisoning my cupcakes, but she doesn't want to talk about it. And again, this is the function of most people. We don't like dealing with mortality, but mortality is coming, whether we want to deal with it or not. And then, unfortunately, we don't know when it's coming. You've read these stories about some guys. There was a story out just the other day. A guy, he's super fit, great, takes great care of himself, eats right, does 50-mile marathon type things. Just dropped dead of heart attack. I mean, like nobody saw that coming. Happens all the time. And these are the things that we can't plan for. And this is why it's important to think about these in terms of not just as you're investing in the markets. And again, it's important to understand what's happening in markets. It's easy for us to talk about managing risk in that aspect. What we can't manage risk for is the things that we have absolutely no idea when they're going to occur. Look, sorry to bore you with it. I just think it's an important point and just something you need to think about. If you got questions, be sure and go by the website, realinvestmentadvice.com. Chris Lieben, who handles all of our insurance, can certainly answer any questions you have. Danny Ratliff, Richard Rosso, if you need help with financial planning, they can certainly help you with that. Just simply ask a question, say, hey, I got questions. I need some help. I'll get you hooked up with them, and we'll get your questions answered. It's important to take care of it. Meantime, get by the website. Daily commentary will be out in just a few minutes here at 7:30. About the time it hits your box, CPI will be released. We'll have an idea of what that will do. And, of course, we'll see how the markets are going to respond to that today. And we'll talk about it tomorrow with Michael Leibowitz right here on the next edition of The Real Investment Show. Have a great day.